In central banking land, the other big story this week was the BOJ raised interest rates, continuing the hiking cycle that it's been in since second quarter of 2024. Um, what this does is it comes right on the heels of the ECB's hike last week, which we've framed as a defensive move, just coming out of the Hormuz crisis, the imbalance of demand for money versus supply of currency, which is materializing and or reflecting lower growth in the European economy, just in response to that resource constraint. What this BOJ hike does is it actually creates extra headwinds in this pool of global capital that all of these economies, these regional spheres, are vying over for liquidity. And what this does, in my mind, is it really steals the thunder from the ECB and that objective of shoring up and pulling purchasing power towards the euro that the ECB is trying to do by hiking rates into stagnation in terms of real economic growth. So Japan's backdrop of below 2% inflation since Epic Fury began on February 28th, combined with its upward sloping yield curve, means that it has headroom for credit expansion in the domestic Japanese banking system. And what that means equivalently is the creation of new purchasing power in the Japanese economy. So that is pulling in liquidity and global capital markets, which really puts another headwind on the European economy, the ECB, and the banks,
Right.
within that banking system. And then you combine that with what the market kind of started to bake in yesterday, post the first Kevin Warsh FOMC press conference. Those may go away, right, as we get rid of forward guidance. Don't be surprised on that. But that anticipation of real economic growth in the US that we talked about, this is all sopping up purchasing power in global markets that the European Union wants and needs to compete for, right? All right. And so slide 12, just to close this out. We're seeing this start to bake into the Japanese yen. So if you think about, this is the chart of the Japanese yen to the US dollar, think about currencies as reflecting relative purchasing power creation in one unit versus the other, right? So whichever unit is, let's say, creating less purchasing power than the other, that currency would be expected to strengthen, just relative, apples to apples. And so what you're seeing here in the last day or two, this 160 level, ever since the Bank of Japan has been hiking since 2024, we've seen this kind of resistance at 160, right? Every time the yen wants to break out above 160, you'll see some sort of action taken to strengthen the yen to prevent that breakout or that weakening of the yen further versus the USD. What we're seeing here headed into quarter end, starting today, really, you saw the Japanese yen break above 160 for, call it, the third, fourth, fifth attempt, depending on how you judge each wick on the daily candle, if it breaks through and comes back in. But these next few days will be key here. And what this is telling you, if the central banks and these sovereign markets are basically saying, between the Japanese banks and the U.S., that they're going to allow the yen to depreciate beyond 160. What that means is they're going to allow the yen purchasing power creation, right, to exceed that of the U.S., which is
Right.
Also going to be growing more purchasing power. The chart I don't show here is the yen versus euro cross rate, right? Because if the yen is allowed to break out and break that 160 level against the U.S., the euro is going to have to come back and fight it, right? Because it also wants to maintain strength versus other currencies like the Japanese yen, the British pound, etc. And so what the U.S. and Japan are doing here will have repercussions for what the ECB is doing. And if you've watched our episodes over, the last year or two we've been doing these, we've been pretty clear with our view that the ECB is the one, the central bank that's being forced to play off of its back foot and everything that's happening.